Alright, you're still watching Investors Guide on ET now. Thanks for staying with us. Dhirendra Kumar is in the studio as well. We're reviewing the Sundaram Select Mid-Cap Fund. Now, we know that this fund is part of several of the portfolios that we have designed. We're taking a look at it to see how it's been doing off late. And before we go into the details, Avan is here to tell us a little more about that fund. Avan.
The fund in focus today, the Sundaram Select Mid-Cap Fund, is a dedicated mid-cap fund sporting an acclaimed track record and outpacing the benchmark comfortably since its launch in July 2002. The fund contains downsides extremely well. During the market rallies of 2006 and 7, it had lagged behind but improved its performance in the more recent rally beginning early 2009. This fund has given its investors an annualized return of 36% since its launch. The fund's top three sectors by allocation are financials, services and chemicals. Let's do some maths to get you a better outlook on the fund's performance over the years. If you invested 1,000 rupees in this fund, you would have 15,027 rupees today. But should you place your bets on this fund, our experts have the answer.
Well, then the Sundaram Select Mid-Cap Fund, we know it's given 36% return since its launch, and this is a fund that you have recommended as part of our portfolios, but only 13% in the last 5 years. Are you still bullish on the way this fund has been moving?
No, it is. I'm bullish on the mid-cap fund. They are supposed to, derive the alpha or get the alpha in an overall portfolio. This was a very impressive fund in its first 5 years. And past 2-3 years, ever since 2008, I think the case for most mid-cap funds or even the equity, all-cap, multi-cap equity funds has been dented quite significantly. But this fund has made a reasonable recovery. Past 5 years doesn't look all that impressive, but I still think that this fund holds promise. It follows a method, and it follows reasonable, diversification. So I would say this fund, on a relative basis, is still promising. One should look at it. It's a mid-cap fund worth having.
When you say generate alpha in your portfolio through a mid-cap fund, what sort of exposure would you recommend someone has to mid-caps in their portfolio? Should it be 10, 15%? Should it be more than that? We know some young people go out and buy all mid-cap funds because they think that it's going to give them big returns. What kind of exposure should I limit myself to when it comes to mid-cap funds like this?
The principle which we have followed in constructing our portfolio is that in our aggressive portfolio we have about 40% mid-cap allocation. In our growth portfolio, it is lower. It is lower down to about 25 to 30%. Most people who try to build a portfolio just by way of mid-cap, I think it's a very dangerous way of approaching your portfolio, because most people think that you have assumed the risk and so return should follow. That is not necessarily true. Some of the things which you should keep an eye on is your core portfolio should be anchored to large cap. You should, at most, if you are very aggressive, go up to 50% allocation to mid or small cap, and try and approach it through portfolios, through funds which are diverse, not necessarily through a small cap fund.
We talked about this last week. I'm going to bring it up again because it's so important. When you say 40% allocation to small caps and mid caps in a portfolio, that can also be achieved through a diversified equity fund that's tilted towards mid cap. I don't have to take that mid cap exposure through a mid cap fund. Are there any of these funds you can recommend to our viewers, someone who possibly can just take an equity diversified fund tilted towards mid-cap, so you're not taking the large risk involved with investing in a mid-cap fund?
Yes, in fact, if you look at all the funds which we have in our growth portfolio, they are like that only. They are all larger mid-cap funds. And HDFC Equity is a classic example. Even HDFC Top 200 is not a large cap fund, though Top 200 will imply that you have the top 200 company by capitalization, so it's or something which is part of BSE 200 has to be large cap, not necessarily. And there are larger mid caps which might be more resilient in a market which is on a free fall, and they help you protect your the scale of decline.
Bringing you back to the Sundaram Select Mid-Cap Fund, your final verdict, your star rating of this fund, is should we be invested in it?
I think it remains an above average mid-cap fund. I would give it a 4 star.
4 stars there for the Sundaram Select Mid-Cap. We heard Virendra Kumar there call it an above-average fund on Investors Guide. Well, moving on, we know that the RBI has been increasing rates continuously over the last 3 months since we entered the new year, and fixed deposits currently are giving you very, very high returns. Here's a look at how you can take advantage of those interest rates in your investments. We know the RBI has been on a rate hike spree since the beginning of the year. The government expects the economy to grow at 9% from April, which means that inflation is here to stay and you can expect more rate hikes.
We do expect a 25 to 50 basis point increase further, and that is really in the repo and the reverse repo rates. But from a market standpoint, I think a fair amount of these future hikes are almost starting to get built in. So in terms of bonds getting traded right now, interest rates being offered right now, some of this may already be priced in.
Now, unfortunately, that means that even though fixed deposits were offering very high returns of up to 10% until March 31st, that's about to change.
Deposit rates have to slightly moderate it. A few of the banks have already reduced the deposit rates in the recent past, and therefore, to my mind, at this point in time, there is no likelihood of deposit rates seeing any increase. On the contrary, it could see a slight decrease.
In March, we had what is known as the March effect on deposit rates, and that's why you saw deposit rates move up a bit. So the March effect is gone, and you're back to normal interest rates.
So if you didn't invest in a fixed deposit, you've missed the bus. So what should you do now? You can still opt for a fixed maturity plan from a mutual fund company, especially if you're in the highest income tax bracket. A fixed maturity plan is a debt mutual fund that will invest your money in fixed term instruments of matching maturity.
It will be useful to lock in to a higher yielding fixed deposit today for a longer term. More so, and it becomes all the more attractive if you are not a taxpayer and dependent on income from investment of a safe kind. And if you are willing to compromise and a time frame of 1 year, possible that you might need that money beyond 1 year, then FMPs could be useful. And FMPs become very relevant for somebody who is willing to take little chances, can compromise on the liquidity, and is in the higher tax bracket.
Now remember, with an FMP, you have to wait for a new fund offer because you can't invest in one off the shelf. Because FMPs don't guarantee your returns, look for the track record of the company that you're investing in.
So you don't have too many things to evaluate on. All you can do is, look for the performance of the previous FMPs which have matured, and have the fund company been able to honor, in earlier cases, what it was expected to. What has been the track record of the older expiring FMPs. That's the only thing to go by.
There is one disadvantage though. FMPs are very illiquid, so it's difficult to get your money out in the middle of a term. So while fixed deposits will charge you 1% withdrawal fees, an FMP might charge you up to 3% for premature withdrawals. So if you can lock away your money for at least a year and you still want those high rates, opt for a fixed maturity plan. Alright, so that's a wrap on this segment. Virendra, thank you so much for joining us on the show and answering our questions. Remember, if you have questions, you can write to us. There's an email ID at the bottom of your screen. We're answering questions on insurance on the other side of this break, so you're not going to want to miss it. Don't go anywhere.